Welcome to our Surviving Market Swing seminar. We're glad that you could join us today. We here at Confidence Wealth are committed to helping you evaluate your financial situation and also want to give you tools to help you make informed decisions and also pursue your financial goals as well. Please note that the information in this presentation is not written or intended as tax, legal, investment, or retirement advice or recommendation as well. And it may not be relied on for the purpose of avoiding any federal tax penalties. One more thing, this presentation is not based off of your unique individual circumstances. So let's get started. We all know a global pandemic made 2020 a particularly difficult year, both financially and emotionally for many. Even so, the S&P 500 price index gained 16% in 2020, which is a surprising performance, often credited to the speedy development of vaccines and massive economic stimulus, which was provided by the Federal Reserve and Congress. So while the S&P 500 is generally considered representative of the U.S. stock market, this recovery was actually powered by technology giants that thrived on the stay-at-home economy. If you look back in August 9th, 2020, the big six tech companies, Apple, Facebook, Amazon, Netflix, and Microsoft, and Alphabet as well, which is, by the way, Google's parent, represented more than 1/4 of the market value of the S&P 500, which gave them outsized effect on index performance. Of course, there is no way to know what the defining moment of 2021 will be, but you can count on market swings to challenge your patience as an investor. Political uncertainty, international conflicts, interest rate decisions, and economic shifts here and abroad can actually spur volatility in the financial market. And it's generally a case of when and not if it happens. So it's only natural to be concerned when the market drops. But expecting volatility and having a sound financial strategy in place may be the best defense you could have when events roll the markets. This might also help prevent you from making emotion-based investment decisions. You see, your plans for the future shouldn't have to depend on daily fluctuations in the stock market. Basically, gains and losses are part of investing. But by using deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to consistently adjust your portfolio to react to today's news. You see, the performance of an unmanaged index is not indicative of the performance of any specific investment. And as an individual, you cannot invest directly in an index. Past performance, of course, is no guarantee of any future results, and actual results may vary. So let's consider how events have influenced the performance of the Dow Jones Industrial Average, which basically tracks the prices of 30 of the largest US companies from 2007 through 2020. The graph you see up there starts just before the financial crisis that led to the Great Recession. Dow stocks fell more than 50% between October 2007 and March 2009. Yet recovered much of their losses during the last 3 quarters of 2009. So stocks continue to climb over the next decade, but not without enduring bouts of volatility. And the Dow last crossed the 10,000 mark in August 2010 and surpassed 20,000 in January 2017. So in 2017, the Dow posted 70 record closings. It's a feat that also set a record and approached the 25,000 mark. The anticipation of tax cuts overcame 3 interest rate hikes by the Federal Reserve, and that's in 2018. And the Dow crossed 26,000 for the first time, but fell sharply in the fourth quarter, and it closed out the year just above 23,000. 4 interest rate hikes, political strife, and a trade dispute with China made it the worst year for the stocks since the financial crisis. Now let's go 2019. The Dow dropped more than 6% in the month of May, mostly due to escalating trade tensions. And in August 14 of that year, the Dow plunged 3% when a yield curve inversion triggered recession worries. After that, the Dow recovered quickly and kept climbing, sending the year above 28,000. Now let's go to 2020, where the threat of COVID-19 and a sudden economic recession sent financial markets into a tailspin, and the Dow dropped below 19,000 on March 18th, and then bounced back quickly to end the year at an all-time high above 30,000. As you can see, the market swing that accompanied the past two recessions, which is 2008 to 2009 and 2020, would demonstrate why overreacting in fear can result in even greater losses. Investors who panicked and sold stocks when prices were falling may not have been positioned to participate fully in the market recovery. So realizing that the markets are historically cyclical may help you stay calm in the face of market volatility. Do you know the difference between a market pullback, a market correction, a bear market, and a bull market? A pullback is typically defined as a 5% to 10% dip in market index, like the Dow Jones or the S&P 500 index, from a recent high. When the market loses 10% to 20% below its 52-week high, it's considered to be market correction. And a bear market is typically defined as a decline of 20% or more from the most recent high, and a bull market is an increase of 20% or more from a bear market low. Beginning on February 19, 2020, worries about the spread of COVID-19 sent U.S. stocks into a bear market for the first time in nearly 11 years. And the S&P 500 index dropped nearly 34% in February and March before it rebounded to a new high by the end of the year. A simple explanation for the disconnect between the buoyant stock prices and the economy that continue to struggle is that the stock market is forward-looking. See, investors believed that the pandemic would be controlled in the not-too-distant future and business activity would return to normal. And that's what happened here. Remarkably, a new bull market began on March 23rd, 2020, when the index closed at its official low point. The 2020 bear market was the shortest in record, lasting just 33 days. There have been 11 bear markets since 1950. On average, bull markets lasted longer, by 1955 days, than bear markets, which are 395 days over this period. And the average bull market advance, 172%, was greater than the average bear market decline, which is 34.2%. The takeaway is that neither the ups or the downs last forever, even if they feel as though they will. So when developing your financial strategy, it is important to consider how overall economic conditions might affect your investment portfolio now and in the future. You should position yourself financially for a range of possibilities, taking into account the factors that may influence the economy and financial markets, many of which are listed here. On June 8th, 2020, the National Bureau of Economic Research, which has the official responsibility of determining U.S. business cycles, announced that February 2020 marked the beginning of a recession. By the way, this is not a surprise considering the severe disruption in business activity due to COVID-19 and the immediate spike in unemployment. One common definition of a recession is 2 more quarters of negative growth gross domestic product, which is the GDP. The value of all goods and services produced across the economy contracted at an annual rate of 5% in the first quarter of 2020. And that's before shrinking by a historic 31.4% in the second quarter. Now, GDP bounced back 33.4% in the third quarter and expanded 4.1% in the fourth quarter. But overall, the U.S. economy shrunk 3.5% in 2020 from 2019 annual level. You see, about 22 million jobs were lost in the first month of the pandemic in April 2020. The unemployment rate spiked to 14.7%. That's the highest official rate on record. Just 2 months earlier, it was 3.5%, a 50-year low. By December 2020, the headline unemployment rate had improved to 6.7%, but more than 9 million jobs had yet to be recovered. You see, the economic turmoil caused by COVID-19 prompted the Federal Reserve to slash the federal funds rate from a range of 1.5% to 1.75% to a range of 0 to 0.25%. That's in March 2020, where it stayed like that through December. And the Fed also implemented a new policy of virtually unlimited bond buying and launched an emergency facilities so that would help stabilize the financial markets. The federal government also passed one stimulus package in March 2020, another in December, which together, I think they provided more than $3 trillion in economic relief for hard-hit households and businesses, among other things. Now, on a positive note, the housing market got unexpected boost from the COVID-19 pandemic because buyers took advantage of low mortgage rates and the shift in remote work. So more spacious homes in suburbs or away from major cities offer less expensive and or more comfortable places to ride out the pandemic. You see, the national median price of an existing home ended 2020 at $340,000, which is an increase of 13.4% over previous December. So what might we look forward in 2021? According to economic projections from the Federal Reserve, the path of economy will depend significantly on the course of the virus. The ongoing public health crisis will continue to weigh on the economic activity, unemployment, and inflation in the near term and poses considerable risk to the economic outlook over the medium term. The projection of gross domestic product growth ranged widely from 3.7% to 5%. The same goes for the unemployment rate, with estimates spanning 4.7 to 5.4%. The forecast for inflation is 1.7 to 1.9%, which is still below the Fed's target rate. The Federal Reserve, though, has pledged to keep the federal funds rate near zero until the labor market reaches maximum employment, and inflation is on track to moderately exceed 2% for the same time. As a result, interest rate hikes are not expected until 2023 or later. Also, approved vaccines should help normalize everyday life, though it could take a while for the economy to regain its full strength. More than 90% of economists surveyed by the Wall Street Journal, by the way, believe that hiring would accelerate in the second quarter of 2021, aided by the distribution of vaccines. Now, these economic projections are essentially educated guesses based on the data that was available towards the end of 2020. Nearly all economic forecasts for 2020 became irrelevant in a heartbeat, and the outlook for 2021 is murkier than usual. The economy could still bounce back sooner or later than projected, and some industries actually may struggle more than others. As always, different series of unseen events could test the economy and investors in 2021. So today, we'll discuss the 4 topics that may help you cope with market fluctuations as you pursue your goals. First, we'll look at how developing a sound financial strategy can create a solid foundation for your investment portfolio. Next, we'll identify a number of investment vehicles and explain the role they might play in your portfolio. Then we will discuss fundamental investment tactics that could help protect a portfolio over time. And finally, we'll look at a few ideas for pulling it all together. You see, developing sound financial strategy may help keep you from being stampeded into making poor investment decisions, especially during uncertain times. There are 3 main considerations to bear in mind when developing a sound strategy. You need to have a clear understanding of your investment and objectives. You need to know your investment time frame, and you need to understand your risk tolerance. So let's look at each of these considerations in a bit more detail. The first step of developing a sound financial strategy is to establish your investment objective. For example, what are you trying to achieve by investing? Are you working towards comfortable retirement? Are you trying to save for college education for a family member? Do you want a cabin in the mountains? You want a trip around the world? Your personal financial goal will basically help determine the appropriate mix of assets for your investment portfolio, depending on which objective you're pursuing, such as preservation of principal, income, growth, and or tax benefits. The second element in developing a sound financial strategy is your time frame. You see, the amount of time you have before you need to accomplish your goal can have tremendous impact on the investment categories you choose. That's because fluctuations in the financial markets can actually affect the short-term value of certain types of investments. If, for example, your goal is saving for a down payment on a house in the next year or 2, your goal is a specific amount of money and your time frame is very short. Therefore, you wouldn't want to invest all your money in aggressive investments that carry a lot of risk. You simply wouldn't have time to recover from heavy losses if they occurred. Now, retirees are especially vulnerable to market volatility. Think about what could happen if a bear market or a market downturn occurred during the early year of your retirement and you had a high percentage of your portfolio in stocks. That could be a disaster. Now, the third element in developing a sound financial strategy is your risk tolerance. You see, determining your risk tolerance means evaluating how much risk you're willing to take in pursuit of your financial goals, including the ability to watch the value of your investment fluctuate without becoming queasy. Generally, the more potential for growth offered by an investment, the more risk it carries. You see, volatility in the markets have tested many investors' risk tolerance and driven home the fact that risk is an essential consideration of a sound investment strategy. So how much risk can you stand? We develop a risk tolerance quiz to help you assess your own ability to withstand risk. There should be a link to download this quiz somewhere in this page. Investing always involves risk. Here are some of the most common types. Economic risk. It can affect some securities. For example, when the economy falters or global growth slows down, corporate earnings can suffer. Though some industries, by the way, and companies may adjust very well to downturns in the economy. Others, particularly industrial firms, could take longer to recover. Another one would be market risk. Effects of most type of investments, stocks, as well as bonds, when the market declines sharply, it tends to pull down the value of most individual securities with it. After a decline, the affected securities may recover at rates more closely related to their fundamental strength. A long-term investing strategy may help reduce the effect of market risk. Another type of risk, called specific risk, might affect only certain companies or industries. For example, management decisions, product quality, and consumer trends can affect company earnings and stock values. Diversifying your investments could help manage specific risks such as these. Bonds and other fixed income investments tend to be sensitive to changes in interest rates. So when interest rates rise, the value of these investments falls, and vice versa. We'll discuss this some more in detail later in this presentation. Bond yields are closely tied to their perceived credit risk, which is the possibility that the borrower will default, i.e. fail to make payment on any type of debt. Default obviously can result in losses of principal and interest, disruption of a cash flow, and collection costs, of course, can become a factor. And finally, there's inflation. The increase in the prices of goods and services over time. Inflation basically poses a threat because it can reduce your future purchasing power. For example, overly cautious investors who place their investments in traditional savings account may not earn enough to outpace inflation. And when you evaluate their return on an investment, it's always wise to consider the real rate of return, which adjusts for inflation. In a very real sense, inflation is the loss of purchasing power. So regardless of how quickly your investments are growing, they're always losing ground to inflation. Here are 4 common items and what they might cost in 20 years, assuming a 3% annual inflation rate. Now that you're aware of these 3 components of the sound financial strategy, let's take a look at some of the common types of investments and the role they might play in your portfolio. When it comes to choosing a sound investment vehicle, most people think of 3 types of investments: stocks, bonds, and cash alternatives. We will spend some time talking about each of these vehicles individually. We will also discuss mutual funds and exchange-traded funds, which are portfolio securities assembled by investment company, and annuities, which are insurance-based products. Let's talk about stocks. Stocks represent shares of ownership in a corporation. When you buy a stock, you participate in the company's assets and earnings. Since stocks can lose money, why should you continue investing in them? Well, compared with other types of investments, stocks overall have had a strong performance record over the long period of time, providing an 11.5% average annual return over the last 40 years. Although stocks tend to be volatile, investors have been able to lower their exposure to the market risk on a historical basis by investing over the long term. For example, based on historical performance of the stock market, over the past 40 years, the chance of losing money in stocks over a 1-year time period was 17.5%. After 5 years, the odds of experiencing a loss declined to 13.9%. And after 10 years, the chance of loss fell to 6.5%. Remember that past performance is not a guarantee of future results. Now remember, investors who keep investment fundamentals in mind may be able to build portfolios that help them smooth out the market normal ups and downs. The price-earning ratio is a simple mathematical calculation which you divide the price per share of a stock by the company's annual earnings per share. The result tells you the price you're paying for each dollar in earnings for that stock. For example, assume you own a hypothetical stock that costs $20 per share, and the underlying company has annual earning of $2 per share. In this case, the stock price per share, $20 divided by the annual earnings per share, $2 equals 10. And therefore, the stock has a PE ratio of 10. You pay $10 in a share price for every $1 annual earning. A high PE ratio is generally considered to reflect market optimism about a company's future. but it shouldn't be taken literally as a basis for an investment. Different sectors of the economy often reflect significantly different PE ratios. Of course, value isn't the only consideration when examining stock investments. You might also estimate how volatile the stock is likely to be using its beta. The beta is usually expressed in a number such as 1, 1.25, or 0.85. This number is a statistical measure of the relationship between a stock expected return and expected return of a broad stock market index, such as the S&P 500 and the Dow Jones Industrial Average. The beta is a correlation with the movement of the market as a whole. So when calculating a stock beta, analysts use a formula that sets 1 as the base for the market. And if a stock beta is 1, the stock will tend to move with the market. When the market rises 10%, the stock can be expected to rise 10%. That's on average. If a stock beta is 1.5, it'll typically tend to be more volatile than the market. So for example, the market drops to 10%, the stock can be expected to drop 15%. So a common misconception is that bonds are appropriate only for conservative investors. However, because bonds are generally less volatile than stocks, they can play a stabilizing role in almost any portfolio. So treasury bonds are long debt obligations of the US government with maturities ranging from 10 to 30 years. The interest earned on these bonds is exempt from state and local taxes, and treasury bonds are guaranteed by the US government as to be timely payment of principal and interest. You look at municipal bonds, they're debt obligations issued by the state, county, parish, or local government, or by some other municipal authority, like a public-owned water district, for example. So municipal bonds are typically issued to obtain funds to build and repair public works projects. The interest on municipal bonds is generally exempt from federal income tax. If you purchase municipal bonds of a state or a city in which you live in, the interest may be actually exempt from state or local income taxes. And some municipal bond interest could be subject to the federal alternative minimum tax. And if you sell municipal bond for a profit, you could incur a capital gains tax. Now let's go to corporate bonds. They're much more a source of corporate borrowing. Debentures or unsecured bonds are backed by the general credit of the corporation. Asset-backed or secured bonds are backed by specific corporate assets such as property or equipment. And these bonds generally have a higher yield than government bonds, but the income they produce is fully taxable. Until you become familiar with bonds, bond investing actually can be tricky. So let's go over some of the nuances in greater detail. Most bonds are sold at par or face value, which is the price which the bond is issued, and they pay interest to the bondholder on a regular basis. When a bond matures, the borrower repays the bondholder principal in full. However, you can sell a bond on an open market before it comes due because bonds' value will rise or fall in response to changes in interest rates. If you sell your bond before it reaches maturity, you may end up receiving more or less of the original face value of the bond depending on interest rates at the time. So when interest rates rise, the market value of the existing bond falls, and here's why. Let's assume you want a bond investment to earn $1,000 over the next 12 months. If bonds are currently paying 6%, you would need to invest $16,666 to earn that amount. If bonds were paying 8%, you would need to invest only $12,500 to earn the same amount. That's pretty straightforward, right? So consider this thought. Let's assume you invested $16,666 in bonds paying 6%, and the prevalent interest rate then rose to 8%. If you were to sell your bond portfolio before your bond mature, how much would you get? That's right, $12,500. Do you see the problem? One way to address fluctuating interest rates is to stagger the maturity dates of the bonds in your portfolio. This strategy is called bond ladder, and it may help limit exposure to low interest rates while also increasing the likelihood that at least some of the principal may be available to reinvest when rates are rising. So you can create a bond ladder over a period of time by purchasing bonds of the same maturity every year or two. Alternatively, you could create a ladder during the same time period by purchasing new issue bonds of different maturities, or by purchasing bonds on the secondary market that are scheduled to mature in different years. For the latter strategy, you might purchase 10-year bond scheduled to mature in 2022, 2024, 2026, 2028, and 2030. Of the major investment categories, cash alternative tend to be the safest, which means that there's little fluctuation in their value. However, if you're locked into low-yielding cash alternatives such as a saving account, a CD, or a money market fund, you'll be subject to interest rate fluctuations, and your investment may not outpace inflation. And that's a key point. So savings accounts usually offer a higher level of security, but relatively low rate of return. They don't require large initial investment, and the funds in them are readily accessible. For many people, their main attraction is convenience and liquidity. Now, CDs are really just a short-term loan to a bank, credit union, or a savings association. They typically offer a moderate rate of return and relative safety. CDs usually require larger initial investment than savings accounts, and you must leave your principal for a term in order to avoid early withdrawal penalties. Now, money market accounts funds invest in a diverse portfolio of short-term financial vehicles. The main goal is preservation of principal accompanied by modest dividend. Money market funds are very liquid and considered to have low risk. But remember, they're not insured by the FDIC. Now, in a low interest environment, the value of low yielding investment may be eroded by taxes and inflation. So when determining how much of your portfolio to devote to cash alternatives or to any other type of investment, keep in mind that taxes and inflation can take a toll on your returns. Let's look at that example. If you invested $20,000 in an account earning a hypothetical 3% rate of return, it would earn $600 after 1 year. For someone in the 32% federal income tax bracket, this amount earned after taxes would be $408. So the after-tax value of the account would be $20,408. After a 3% hypothetical rate of inflation is applied to the balance, the real rate of return on the investment is negative 0.93%. In this case, your investment would actually have lost money. Of course, remember that this is an example and it's hypothetical and just used for illustrative purposes only. Now, selecting individual investments can be a complex process that requires specialized knowledge, time, and attention. That is why many people invest in mutual funds and exchange traded funds, ETFs, so they could add a mix of stocks, bonds, and cash to their portfolios. Mutual funds and ETFs are portfolios of securities assembled by an investment company. Their underlying investments are typically selected to track a particular market index, asset class, or sector, or they may just follow a specific strategy. Because these funds can hold dozens or hundreds of securities, they could provide greater diversification at a lower cost than you might obtain by investing in individual stocks and bonds, of course. Now, here's a list of the different types of mutual funds, ranging from lower to higher risk, that cater to different groups of investors and their common goal. Money market funds. They invest in short-term debt investments such as commercial paper, CDs, treasury bills, money market funds. They're neither insured or guaranteed by the FDIC or any other government agency. Although money market funds attempt to maintain a stable $1 share price, you still can lose money investing in such a fund. Now let's talk about municipal bond funds. Generally offer income that is free of federal income tax, and income may be free of state income tax if the bonds in the fund were issued from your state. Remember, although interest income from municipal bond funds and some money market funds may be tax exempt, any capital gains are subject to tax. Also, income for the same investors may be subject to state and local taxes and federal alternative minimum tax. Now let's talk about income funds. They concentrate their portfolios on bonds, treasury securities, and other income-oriented securities. And they may also include stocks that have history of paying high dividend. Bond funds are usually subject to the interest rate, inflation, and credit risk associated with the underlying bonds in the fund. As interest rates rise, bond prices typically fall, which can adversely affect a bond fund performance. Predictably, balanced funds and growth and income funds seek the middle ground between growth fund and income fund. They include a mix of stocks and bonds and seek to combine moderate growth potential with modest income. Now let's talk about growth funds. They invest in stocks of companies with high potential for appreciation, but very low income. They're more volatile than many types of funds out there. Let's talk about international funds. They invest in foreign stocks and bond markets, sometimes in specific countries. Global funds invest in combination of domestic and foreign securities. There are increased risk associated with international investing, as you know, including differences in financial reporting, currency exchanges risk, economic and political risk, which are unique to specific country that you're investing in, and also have a greater share of price volatility. Now let's talk about sector funds. Sector funds invest almost exclusively in a particular industry or sector of the economy. Although they offer greater appreciation potential, the risk level is also higher. So investments seeking to achieve higher rate of return also carry an increased level of risk.